Good morning, ladies and gentlemen, and welcome to the show on this Monday, the 3rd of May, 2021. Thank you for tuning in. Starting in 2008, the government, instead of letting the markets purge themselves, because that's the way it's supposed to happen. Companies, when they made big mistakes and they put money where they shouldn't have put it, and they should go bankrupt. This is the way to cleanse the system. But instead of letting big crony capitalism, letting it go down, letting it sink, and letting it purge the system in 2008, what they did was they started to transfer risk. They bailed them out, in other words. And each time they bailed out a company or a corporation, and they've been doing it ever since 2008 till now, they've been transferring the risk from the corporations and from the financial system over to the government. Well, where does this risk settle that they've transferred? Transfers into the bond market. But the bond market is so huge, and what it's yielding is a never-ending transfer of risk. They're not going to stop. They're going to continue. The risk of everything. The risk of, okay, the world catches a pandemic. We're going to build the world out for 8 trillion or whatever. I mean, when I even say that number, it's just ridiculously large. Where are they transferring that risk? Into the bond market. And, the bond market has been like in a 30, 40-year bull cycle. Bond yields are the lowest they've ever been. And threatening to go lower. But it all has to end at a certain point in time. Because the transfer of risk will never end. And it's going to be a certain point where investors are going to say, hey, look, the government is so far in debt, billions and trillions and trillions and quadrillions in the end, that how on earth, I know they can pay for their bonds, but it starts to, that risk transfer yields something that's going to happen from that. In other words, you get an action, you get an equal and opposite reaction. This is the law of the universe. So what is that reaction into the bond market? It means that there has to be a default in the end. Now, a deflationary cycle, if they let the system deflate, that default would be in the bond market. Yields would be unbelievable. If you think yields were high back in the 1970s at 20%, it'd be nothing. The bond market would rocket. It would be a rocket to the moon, the yields on bonds, because of that transfer of risk, the amount of risk that they've assumed into the government over these years since 2008 till now. And that would be one way that they could default on the bonds, or default on that. But there's another way. The government, they're not going to ever accept that type of default. So the only opposite direction is to keep yields even lower, to keep the bond market in a bubble, and to settle this risk by constantly expanding the debt and taking on more risk. And ultimately what this does is, this is a default too, but it's a default in the opposite direction. It's a default where the money that those bonds represent becomes worthless in the end. That's where they're going to go. There's no other choice other than to default on the bonds. The bonds become worthless, as in the yields shoot to the moon. They can't let that happen. It would blow up the financial system, and it would blow up the system to where the system would freeze. And I've been talking about this lately, They're never going to go in that direction. They're always just going to keep transferring that risk into the bonds and keep the bonds yields low. If you think what happened to Japan is going to happen here, this is a totally different situation. In this situation, what's going to happen is we're going to see massive inflation. We're going to see what you can purchase with that money just go down the toilet. In fact, the dollar in the end is going to go down the toilet. So, I'm going to tell you guys, bonds right now are considered to be the least riskiest asset class, a safe haven asset. It's the biggest joke in the world. you know. And I'm going to tell you something else too. Well, let's get the chart started right here, and then I'll talk as I'm going along. First, we're going to take a look at the silver price, which is starting to go to the upside. Why they suppress this price using the paper contracts. Why they do that is the gold and silver price reflect upon the dollar. If gold and silver prices go too high, it makes the dollar worthless. So they have to protect the dollar by keeping the gold and silver prices down. Now, but what about lumber prices? Lumber prices do not reflect upon the dollar, but lumber prices reflect upon the housing market and the real estate market, which is in a bubble, and they want to keep it in a bubble. So they're perfectly okay with allowing the opposite type of manipulation with lumber, allowing it to be manipulated to the upside to protect the real estate market. Perfectly okay with that. Believe me, this price surge in silver today is not because of their manipulation. Their manipulation is to the downside. Silver's taken off because of the fundamentals in this situation, and the knowledge that in the future silver's gonna and gold are gonna both have to take off at a certain point. It's like holding a beach ball underneath the water with your hands. Eventually that thing's gonna pop up, and that's the way with silver and gold. But they might try to crush it again. But that paper rigging game they got going, it's only going to be as good as the amount of physical silver that's underlying the market. So if physical silver starts to disappear, you're going to see that the paper rigging game can't go on any longer. Because either that, or you're going to have tremendous premiums, and you're going to have a separation in the price between real physical price and the paper contract price. And then there would be more and more people standing for delivery on the paper contracts, and they would have to switch it over so that they can't get delivery anymore. The only thing that they can do now is just take paper instead. Dollars, settle in dollars. Anyway, let's move on. We're taking a look now at silver, and it's up today, but I'm like, whenever I see it go up like this, I think to myself, they're going to rig it back down again. That's what I think to myself. But one of these times, it's going to take off like this, and this might be the time, or it might be in the future, and then they're not going to be able to rig it back down. Okay, so $23 up for gold, $17.92. Let's take a look now at cryptos. Cryptos is at $2,285,000,000,000. We're looking at a Bitcoin dominance that's very low, 47.4%. What this indicates to me is the stage of the rally we're in, the stage of the bull market. With cryptocurrencies, what happens is your Bitcoin dominance falls mid-bull market. And as that Bitcoin dominance falls, they start to buy into the altcoins. That's why the Bitcoin dominance is falling. And they feel very, very secure in the price of the altcoins going up in the future. That's why they're buying in. But when the first bit of insecurity starts to come, when you start to near the end of the bull market, then you see them reverse, and they start to go into Bitcoin as a safe haven in the crypto space. And the altcoins start to fall in, and then the Bitcoin dominance starts to rise again. That's when you need to really watch out, because you're getting near the end of the rally. Now, Bitcoin always goes through rallies. It's going through a rally right now. It's went through like 11 of these, or 12 of these since it began. And it's always the same thing. The price surges way up high, and then what happens is it falls off, and then it stays stagnant for a while. Maybe for a year, maybe for 2 years, maybe for only 6 months, where it's in a bear market. And then it gets ready to go into its next big rally. This rally right now, we're either in mid-rally or getting towards 3/4 of the way. Maybe we're halfway, maybe we're 3/4, maybe we're 90% through the rally. We're somewhere in along there. We're in this rally. We're going to stay in this rally until you see that reversal. Bitcoin dominance starts to rise again. That's when you got to start to watch out. That hasn't happened yet. When you see it, when you see that happen, that's when you start to have to worry about the rallies coming to an end. But there's going to be another rally, guys. When this rally ends, we'll go into a little bear market for a little while. Gosh only knows how long that'll last. If I knew how long that would last, I mean, I could make all of you rich. I don't know how long that bear market's going to last. But then we'll go into another rally. This next rally that's coming up, after we go through the next bear cycle, is going to be the big one. If they don't do something to destroy Bitcoin, and I don't think they can at this point, or you know, I don't know what they would do to try to get rid of it, but if they don't get rid of it, Bitcoin is going to succeed in its final goal. Its goal is to become the world reserve currency. That's Bitcoin's goal. And Bitcoin will succeed in that goal if it's not stopped. And it will basically, it'll become the new gold standard for the world. Quite seriously. Gold standard for value. If they don't stop it. It's on an exponential. And that's what it's trying to do. It'll take on more and more trillions. It'll just keep sucking up trillions. Until in the end it's standing on top of the world. If they don't stop it. Okay, so now what we're going to do is we're going to take a look at the Dow Jones Industrial Average. 34,184. It's up 309 points on the day. You know, I'm going to tell you, the bond market is so much bigger than the equities market. You know, the Dow Jones and all these other markets. The bond market's the hugest market. Oh my goodness. But it's all that transferred risk. The more risk they transfer, the bigger the bond market gets. The more it, you know, I mean, it's just this never-ending game that they're continuing to play. They're going to keep these yields down. If they try to raise these yields even a little bit, the markets are going to start to crash, and then they're going to have to bring the yields back down again. And this is a never-ending game of money printing. Where the bonds, what you can purchase with those bonds, what you can purchase with your dollars, is going to slowly disintegrate. And meanwhile, Bitcoin and the cryptos are taking advantage of this. This is what made them in the beginning anyway. This is what fueled them all along. They would be worthless right now. They wouldn't have any value if it wasn't for this paper rigging game that's going on, this Ponzi scheme. Okay. Taking a look at crude oil today, 64.50. And it's up 92 cents, or 1.45%. Now, if you go on to the MOVE Index, and I'll tell you what the MOVE Index is, and it's falling today, and I'll explain it. This is your credit markets. Falling is good. Falling means that there's stability in the credit markets. 58.13 today. When the MOVE Index goes over 75, instability starts to enter into the credit markets. When it goes over 100, the instability is becoming severe. And this is one of the major indexes that the Federal Reserve watches, this MOVE Index. They watch it like a hawk. Because as long as it remains low, like it is, that means that all their big games of manipulation are working pretty good, you know. Like when we saw the repo crisis back in September of 2019, there was instability in this index right here. Okay, so that's why we watch the MOVE Index, is because the Fed watches the MOVE Index. Bonds and rates today. The Fed watches this really good too. They watch the 10-year. 10 years at 1.60. It's down 2.3 basis points. You notice that the Fed's hand is in this market. I guarantee you that the Fed's hand is in this market right here, in the U.S. Treasury market. And their hand is to keep it suppressed, to keep it down low so the system doesn't crash. And they don't want to come out and say, hey, you know, we're controlling this, but they're controlling this. They're not going to let these yields go too high, you know. I think that they will let the 10-year creep up to around 2% by the end of the year, but it's limited how much higher it goes past that. I think that's like a hard line in the sand, around 2%. You know, depends on what the Fed exactly wants to do. If they want to crash things a bit, and cool down inflation, then they might let these bond yields go up a little bit. But they don't want to crash the system. So it's a difficult, very tender thing, to not crash the system, but to let things crash just a little bit to temper inflation. They're trying to play this game between inflation and deflation. They're trying to make a balance there so that the dollar doesn't get destroyed in a hyperinflation. They're terrified of inflation. They're not frightened of deflation that much, unless it were to get out of control. And they got the printer. They can stop it from getting out of control. In fact, they can crush deflation. But deflation is useful for them. It's useful because they can use it as a tool to give strength to the dollar and to cool down inflation. An awful lot of things in the financial system, you have to understand, are perception. And right now, amongst investors in the investor world, they're divided. A lot of them are saying, hey, we're going to have a huge deflation. And there's another camp over here that says, hey, we're going to have a huge inflation. The Fed wants to keep them divided on this issue. Control through confusion, and keep them so that they don't know which way the markets are going to go. So they don't know whether to invest in dollars or to invest in gold. And they're sitting there on the fence and they're saying to themselves, I'm going to stay in dollars. Whenever you get a person that says, I'm going to stay in dollars, well, he's helping to keep the dollar up. But think about this. Why on earth would they be able to print endless currency units, the dollar, and have it maintain value forever when they're printing endless amounts of it? Does that make sense? Really? Okay. If we move on to the U.S. dollar index, we're looking at 90.93, and we're seeing a down day for the dollar today. It's down 90, oh, no, 30, is that 30? My eyes. Anyway, it's down 0.38%, the dollar. 90.93 today. I got that thing, where I sometimes I need glasses, sometimes I don't, but anyway, listen, you get to reading glasses. Sometimes I need reading glasses now. I remember when I was a kid, boy, oh boy, I had some terrific eyesight. I remember being able to read somebody's page from a book like 10 feet away, but that goes with age. And in the end, your eyesight, in the end, you get so you have to use reading glasses, and it gets fuzzier and fuzzier. It's the biggest pain in the arse is having to use glasses to read things, And they always make prints so damn small. Microscopic. When they got room on the page to make the print size, the font's larger. But they don't. They make them microscopic on just about everything, especially when they're putting in ingredients and stuff. Like if you buy a package in the store, and they got the ingredients listed. They're microscopic, for crying out loud. Or if they're getting you to sign something where they want to take your money away from you, and all of the fine print down there, it's just like microscopic, It reminds me of the Willy Wonka movie when he was getting the kids to sign the contract, and the print was microscopic. Needed a magnifying glass to try to look at it. Anyway, listen, thank you guys for listening to the show. Like and subscribe, and we'll catch you guys in the very next episode. Bye-bye.